In this presentation, we will discuss our objectives as we enter the beginning data into QuickBooks Online. Here we are in our Get Great Guitars file. We want to discuss our objectives now that the file is set up in terms of how we're going to get the beginning data that we need in order to then process forward from that point. This is going to be a financial statement that we're going to use in order to enter our beginning balances into the system. In other words, when you start a new company file within QuickBooks Online, it may be the case that you're starting totally from scratch and you have no other information that you need to be entering in terms of the beginning balances. Or you may have some other accounting system that you already have financial data in from the prior system. You need to enter it into the current system as of a certain point in time. And that would mean that if you move forward from that point in time, you want to be in the current system, QuickBooks Online. Prior to that point, you would want the data from the prior system. Or you may have just some things that you have set up already, but you have no formal accounting system yet. In other words, you may have set up a checking account already. You may have some equipment already set up that you have and whatnot, but you've never really put that into a formal financial statement format, but you'd like to have it on the financial statements when you start the organization. So we're going to basically imagine here that we have prior data. We've got the prior data from our prior accounting system. We haven't been doing a whole lot, but we have our prior data. We want to set up those beginning balances into the current system, and then we want to basically be able to go from there pushing forward in the current data that would all be in the current system. Now, as you do this, note that you want to be able to do this as of the beginning of the year if possible. In other words, if you're a calendar year end, if you have a January through December calendar year, you would like to be transferring this data in as of the beginning of the year and put all the data in the current system as of the beginning of the year. If you have to do it in the middle of the year, it might be a little bit more difficult. Now, if you're starting the company in the middle of the year, that's okay because you probably aren't going to have any data in the prior time period. But we'd like to basically start, at the beginning of the year. Typically, that would be the easiest thing to do in most cases. So what we're going to do then is we're going to say, hey, the cutoff for the last financial statement is 12/31/19. Anything prior to that, you need to take a look at whatever system we had prior to using this QuickBooks Online. Anything after 12/31/19, in other words, starting January 2020, will be in QuickBooks Online. And if you want any data, the detail of it from that point going forward, then the current file that we're putting together is the one you want. So this is going to be the data we had prior to this. Now, our objective then is to get these beginning balances into the system as of the first date that we're going to be working with, January 1st, 2020. So that means that the December 31st, 2019 is the prior period, and then we're going to start entering data for the current year, January 1st, 2020. So how can we go about doing that? Now, you would think that you could just basically do one journal entry and enter all this information in with basically a journal entry, and you can, but there's some added problems that we have to include as we go through this process as well. And we also want to enter some more information as we start the company file, including adding service items that we can help to populate the invoices with, and adding inventory items to help us populate that information, as well as if we have any customers or vendors outstanding. So what we're really going to do then in QuickBooks, what QuickBooks is designed to do, is basically to enter each of these beginning balances basically one at a time, adding any kind of special needs that you need. And then that's only going to be one side of the journal entry. We'll think about these one at a time, each asset account, each liability account. And then QuickBooks will kind of do whatever it needs to do to whatever other side of the transaction it will do. We'll let QuickBooks just basically, because every transaction needs two accounts affected. So if I enter the cash account and I just tell QuickBooks, hey, here's the beginning balance, QuickBooks is going to have to put the other side somewhere. We're going to let QuickBooks do that. It just puts the other side wherever it wants to. And if it puts it in the equity section, fine. If it puts it on the income statement, that's okay, because the income statement will then roll over into the equity section after that point in time. So everything will work out as long as we're going to look at each account basically one at a time, let QuickBooks kind of force the other side of the journal entry to happen, and then everything will basically wash out in the equity section. That means when we enter this data in the system, we want to make sure to enter it as of 12/31/19, the prior date, so that any of the temporary accounts, the income statement accounts, aren't affected in the current period, 2020. So if we go through these, for example, we'll enter, say, the cash balance, and we'll enter the cash balance. The problem with the cash balance is you've got to reconcile cash as well. So we'll deal with outstanding balances And we'll talk about that when we do the bank reconciliations. But we need to enter this beginning balance in cash just to basically reconcile. So that's what we'll start with. We'll enter the cash balance in cash, and then we'll deal with the reconciliation process at a later time. We'll just simply enter the beginning balance. If you look at accounts receivable, then we'll go into accounts receivable. We may not go in the same order, but we'll enter the accounts receivable balance. The accounts receivable has an added problem, however, in that this must represent people that owe us money. So we can't just do a journal entry. We also have to give QuickBooks the information on who owes us the money. Therefore, we're going to need more detail than just this amount. So it's going to be a little bit more complicated than just telling QuickBooks, hey, this is the beginning balance, and doing a journal entry, because we have to add the detail of who owes us that money, meaning we have to add the customers. So we'll add customers at that point in time. We're going to deal with the asset account, the inventory asset. This is how much physical inventory we have, which again, we can't just put on the books with a journal entry, because if we were to do so, we wouldn't have any supporting data about the type of inventory that is there. And so again, we're going to need more detail. We're going to actually add the service items and these will be inventory items. So we're going to have to tell QuickBooks what type of inventory we have if QuickBooks is going to help us to track that inventory. As we do that, it'll also help us to set up those items, they call them inventory items, service items, that will also be used to help us populate the forms that we'll be using, those being the invoices, the sales receipt. When we go down here, we have the machinery and equipment. So these are depreciable assets. Again, we'll tell QuickBooks, hey, here's the beginning balance here, and QuickBooks will do whatever it needs to do to the other side, putting it into equity in some way, shape, or form. Then we'll go to the accounts payable. And again, we might not go in exactly this order, but we'll enter accounts payable. And it's not so easy as just a journal entry either, because we have to enter not only the amount, but who owes us that, or who we owe that money to. So we actually have to enter the vendors that tie to that accounts payable as well. So we'll deal with that. And then we'll go to the credit card. We'll enter the beginning balance for the credit card and let QuickBooks put the other side to basically equity in some way, shape, or form. And then we'll go to the notes payable, like a loan, we owe something to the bank. Again, we'll tell QuickBooks what the beginning balance is and let QuickBooks do something to the other side, typically putting it to equity in some way, shape, or form. Then we have the equity down here. Now, this equity is not something that we're going to put into the system. What we're going to do is put everything else into the system. And as we do that, QuickBooks will kind of force some other side of the journal entry. As we enter every account in one side at a time, it'll have to force the other side to go somewhere. And QuickBooks will always force it to either go to the income statement, profit and loss, or to the equity section. And if it goes to the income statement, it'll roll over into the capital account at the end of the period, which is going to, for a while, be retained earnings in QuickBooks until we change the name of it. We can change the name of it to capital. Or it'll put it to this account called opening balance equity. And so either way, the total equity will be fine. Then at the end of that, we'll just clean up the equity section. So in other words, we would like to have it in the capital account. We'll clean out the opening balance and account to just have the capital account to be fairly represented. So our objective is, in terms of the numbers that we have, is to enter each of these accounts in one at a time. Tell QuickBooks basically only one half of the journal entry. Let QuickBooks then force the other half, which will affect equity in some way, shape, or form. Then we will fix equity with a journal entry, just basically journal entry between the type of accounts that are included in equity, and rename the equity account if we need to, such as retained earnings being renamed to a capital account. Notice what we're not dealing with is any income statement account. When you start a new file from scratch, you don't want the income statement accounts because they have already been closed out. Those are temporary accounts. So you'd like to start at the beginning of the year, in which case you don't have any income statement accounts, even if you've been in business in the past, because they've all closed out. They're going to close out to equity as they do every year. That's just the way it goes. So that's why you want to start at the beginning of the period, and therefore only have to enter the beginning balances for the balance sheet accounts and let the income statement accounts just flow through to the balance sheet. And then going forward, we'll have those income statement accounts affected simply for the current year that will measure performance over that current year. Also, as we set this stuff up, like we say, we'll have to enter, and we'll be able to go through some of the special things we need with each account, such as the bank reconciliation will be needed up here. We'll talk more about that later, and such as the items for the inventory items that we're going to need to be setting up, which will help us for creating sales invoices and sales receipts, the customers and vendors. We're going to show how to set those up as we go through this process as well. So we'll both be entering the balance that we need to be entering for the beginning balance and some of the data input information we will need in order to generate and make forms in the future, which will help us to create the financial statements in the future as well.